Let's kick off this explainer and finally clear up the massive confusion around how federal tax brackets actually work. You know that sinking feeling when you look at your pay stub after a raise, or when you're just totally baffled by how the IRS calculates what you owe? Yeah, you're definitely not alone. Taxes can feel like a total black box, but today we're ripping that box wide open. We're going to look at the exact mechanics of the progressive tax system, using some really solid insights from Charles Schwab's latest financial research. Honestly, this is going to completely change how you view your taxable income.
So, to make this super clear, here is our roadmap for today. We're covering 1. The tax bracket myth, 2. How brackets actually work, 3. Marginal versus effective rates, 4. What impacts your rate, 5. Smart planning for investors, and 6. Other common tax questions.
All right, Section 1. The tax bracket myth, busting common fears. Let's start with the most damaging misconception out there about earning more money. We have all heard this fear, right? You get a promotion, or maybe your business just has a killer quarter, and suddenly, panic sets in. You realize this new money is going to push you into a higher tax bracket, and the immediate thought is, wait, does that mean all of my hard-earned income gets taxed at that new, higher rate? Is this raise actually going to leave me bringing home less money?
The short answer, no, absolutely not. See, the IRS uses what's called a progressive tax system. So instead of thinking of your income as one giant lump sum, think of it more like a cake made of distinct layers. Only the income that physically spills over into that specific higher layer gets taxed at the higher rate. The foundational layers of your income, they stay perfectly safe, taxed at their original, lower rates, no matter how tall your income cake gets.
Moving right along to Section 2, how brackets actually work, visualizing the layers. Let's ground this in reality by looking at the 2026 tax brackets for a single filer. This shows exactly where each layer of taxation begins and ends. The rates step up progressively, 10%, 12%, 22%, and then 24%. It really helps to just picture these as buckets. Once your income completely fills up that first bucket at $12,400, the rest just spills over into the next one. Let's put some real numbers to this. Say you're a single filer, and after all your deductions, you have exactly $100,000 in taxable income. Because $100K falls between $50,401 and $105,700, you are technically in the 22% bracket. But watch how the progressive system actually protects you. Step by step, your money fills those buckets. Your first $12,400, taxed at just 10%. Then the next chunk, from $12,401 up to $50,400, is taxed at 12%. Finally, only that remaining money, the bit from $50,401 up to your $100,000 total, actually sits in that 22% bucket.
So, what does this actually mean for your wallet? Your total tax before credits is $16,712. Think about that for a second. If the myth were true, and your entire $100,000 was slammed with a flat 22% tax, you'd owe $22,000. Because of this layered system, you're literally saving thousands of dollars compared to what most people assume happens. Bottom line, moving into a higher tax bracket never ever penalizes your underlying income. Let's jump to Section 3, marginal versus effective rates, understanding the math.
Understanding this math gives us a really clear contrast between two terms that constantly trip people up. Honestly, misunderstanding these leads to so many bad financial decisions. When people talk about their tax rate, they're usually blurring these two together. But look, your marginal rate is simply the highest tier you hit. It's literally just the tax rate on your absolute last dollar earned. Your effective rate, though, that represents the true average percentage you pay overall. You find it just by dividing your total tax bill by your total taxable income. Going back to our $100,000 example, even though the marginal rate, that top bucket you tipped into, was 22%, your effective tax rate is actually a much lower 16.7%. Whenever you're budgeting or trying to figure out how much of your total income the government is really taking, the effective tax rate is the one that tells the real story. And as a general rule, your effective tax rate is basically always going to be lower than your marginal tax rate.
All right, Section 4, what impacts your rate? Let's look at the variables that actually matter.
Because honestly, it's not just your salary that counts here. The IRS runs your taxable income through a whole gauntlet of variables. First up, your income sources. So wages, bonuses, interest, dividends. But then you've got your adjustments and deductions. Things like your filing status, whether you take the standard or itemized deduction, and if you're making pre-tax contributions to an HSA or a traditional IRA. These things actively shift how much of your income is exposed to those higher brackets. Think of it this way.
These adjustments physically shrink the size of your income cake before the IRS even gets a chance to slice it up into layers. Section 5. Smart Planning for Investors. This is all about keeping more of your money.
Now that we know how to spot the leak, let's play some offense. Imagine you're cruising along, perfectly settled in the 24% bracket. But then, bam, you get a massive end-of-year bonus. Awesome, right? Except that bonus threatens to push a chunk of your income up into the 32% bracket. So what do? Well, you can strategically shield that money. You reduce your taxable income for the year by shifting those bonus funds straight into a tax-deferred retirement account, like a 401k. You are essentially intercepting that top layer of income before it hits the 32% bucket and moving it to safety.
By contributing just enough of that bonus to keep your taxable income perfectly within that 24% layer, you effectively save a massive 8% in taxes on that extra cash. It is such a brilliant move. You keep the money for your future self, and you instantly grab an 8% return on it just by sidestepping that higher marginal tax rate. That right there is the power of proactive tax planning. Finally, Section 6, Other Common Tax Questions. Let's do a rapid-fire round looking beyond just ordinary income.
Because the IRS definitely looks at more than just your paycheck. A really common question from investors is, do capital gains push you into a higher tax bracket? Basically, if I make a big profit selling some stock, is that going to hike up the tax rate on my normal salary?
The answer here requires a little nuance. Yes, capital gains absolutely increase your overall taxable income. However, long-term holdings, so assets you've held for more than a year, they get treated to their own separate, much lower rates of 0, 15, or 20%. Because of that, they won't alter how the ordinary income from your day job is taxed. Now, the flip side is a bit different. The extra income from those capital gains could push your total income high enough that your gains are taxed at the higher 20% capital gains rate instead of 15%, but your ordinary income brackets, totally unaffected.
Next up, is Social Security income taxed? This is a huge concern for retirees trying to map out a fixed income. Do you have to hand part of your Social Security back to the IRS?
Unfortunately, the answer is often yes, and I know that can be a tough pill to swallow. The IRS calculates this combined income figure by taking your adjusted gross income, adding any non-taxable interest, and then tacking on half of your Social Security benefits. Depending on that combined total and your filing status, up to 85% of your Social Security benefits could actually be subjected to those standard federal tax layers we talked about earlier. If you're approaching retirement, this is an absolutely crucial factor to plan around.
All right, we've unpacked the layer cake, busted the big bracket myth, and shown how strategic contributions can actually shield your wealth. Understanding these layers literally puts the power back in your hands. You don't have to just blindly accept whatever the bottom line says. So, knowing how your income actually flows through these progressive brackets, what specific adjustments are you going to make today to legally shrink your tax bill?